Good evening, members. Welcome to the study circle meeting on SME opportunities for SME, MSME, private limited companies under accounting standard and the companies law. Before we start the actual session, let's rise for the institute.
सुप्तेषु जागृति य एष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
So, last few years, government has provided many privileges to the SME and MSME segment, and also in the recent past, they have provided for private limited companies. So we have with us Janak Bathiya, who will take it through this topic on the MSME. And before that, I request my colleague Sikandar Yadav to briefly introduce our learned speaker.
Thank you, Hiran Bhai. It is a great pleasure and honor to introduce today's speaker, Mr. Janak Bathiya ji. He is a practicing lawyer and counsel. He specializes in the field of corporate law, security law, and real estate. He is a member of ICI and ICSI. He is a managing partner at the law firm Bathiya Legal. He has also been an active speaker on various topics at various forums in the profession, including various management institute, ICI and ICSI. With this brief introduction, I request all the members for virtual applause. Now I would like to present e-memento to the speaker.
Thank you. Thank you so much.
Thank you, sir. Now you can start the presentation.
Okay.
Thank you, sir.
Thank you. Thank you, everyone on the panel, on the screen, virtually on the dais, and all the participants who have joined us today. I hope I am audible enough for everyone. Okay.
Yeah, it's perfect.
Great. So I will just share the screen. So is the screen visible?
Yes, sir. Yes, sir.
Okay. And are we also having the photographs on the screen, or are you just able to see the presentation?
Presentation is there, sir.
Okay, great. So our videos are not coming on the screen, right? I can see the videos, but I hope you're not able to see those.
Yes, sir.
Okay, great. So good evening, everyone. Thank you for having me here. Today, the topic that was given was, privileges and opportunities for MSMEs, particularly having regard to some aspects of accounting standards and company law. I've tried to touch upon certain other aspects as well, which if we have time, we will touch upon during the course of the presentation. At any point of time, if anyone has any questions, then I'm sure you would be able to raise hands on your screen, and maybe Hiranbhai and team just let me know if there is someone.
There is a question answer box, so they can put all the
Okay.
questions in that, and we
Great.
can read out for you.
Great. So I think it is by way of the chat box, so you could mention there, and we could take it up. We could try and take it up. Whatever we are able to address during the session, we'll address during the session, or maybe take it up at the end, or maybe then take it up offline as well. So yes. So I think we've tried to I've tried to kind of give a terminology to because it's a very complicated thing, whether you call it MSME, whether you call it SMC, whether you call it SME, whether you call it SSI, whether you call it small company, whether you call it one-person company, dormant company, small LLP, startups, so many things together. So for simplicity, let's call it younglings, and this is something that we are just using for convenience. It does not have any legal value. So before we get into the specific exemptions that are available in relation to MSMEs under law and whatever privileges are granted, let's just have a background of what these younglings are, what do they contribute for the economy, what kind of value add they make to the economy, and why they are so important for a country like India. So as per a 2016 survey, there were a staggering 6.3 crore MSMEs in the country, with an almost equal distribution, in manufacturing, services, and trading. So you can imagine in a country of 130 crore people, 6.3 crore MSMEs exist, and they create 12 crore jobs. Again, equally distributed in manufacturing, services, and trading. So, and they also contribute 30% to India's GDP, and 50% to the total exports of India. So that important is how MSMEs are to India. They are a very critical pillar for India's growth, and if India has to grow, the MSMEs of the country have to grow, and for them to grow, they have to be facilitated with various privileges and opportunities in order to enable them to grow. Now, even chartered accountants qualify under the MSME category, and some of those numbers may also include, chartered accountants or other professionals. So we will get into the NFRA controversy if required at the end of the session, and how that is taking shape in terms of to help MSMEs. Are we kind of also attacking other MSMEs? Now, see, until September 2021, there are 50 lakh MSMEs that have been registered on the new Udyam portal and have obtained the Udyam registration that is there for MSMEs. Now, this is in a period of 18 months when this Udyam registration was launched. In that time, 50 lakh MSMEs have already been registered. Uttar Pradesh, West Bengal have the highest number of MSMEs, and Maharashtra being the fourth in terms of the number. Now, all of us know in terms of the private limited company number, we have 12.5 lakh private limited companies. But also another important thing to note is that India is the third largest startup ecosystem in the world, and is expected to witness a year-on-year growth of 15%, which means that if we get this right, this is going to help us a lot in terms of improving our economy, particularly GDP and employment. Now, the Department for Promotion of Internal Trade they recognize startups. We all know that. So 50,000 startups have been recognized by the Department of Promotion for Internal Trade. And that means 50 startups per day. Now, not all startups that are registered with that department have the benefit of the income tax exemption, because that's a very minuscule number if you really go to see. But 50,000 startups have been recognized, and various benefits are available apart from income tax to these startups. Now, these startups have contributed significantly to the job creations. These particular startups have created a jobs of 5.5 lakh, that have been reported by around 48,000 startups. So typically, you would note that around 11 employees per startups are getting employed. So it's a significant number when you see how a typical MSME would contribute, 2 jobs per MSME, whereas a startup is contributing 11 jobs per MSME. Now, why does India have such a large number of MSMEs? Various reasons, at a macroeconomic level, entrepreneurship. A lot of entrepreneurs in India, but particularly young entrepreneurs, because as we all know, the demographic dividend, and India is kind of one of the younger countries, and therefore a lot of young enterprises leading to more number of MSMEs. A lot of opening up that has happened over the past few years or decades has also kind of led to a lot of MSMEs being there and lesser number of bigger corporations. Now, limited access to finance again, hinders MSMEs to become large corporations, and lack of an ecosystem that was there until a few years back. Now the present government has been trying a lot to, improve the MSME environment. At least there is some kind of recognition that is given to startups, and they feel recognized like all other startups in all other countries. Now, what are the typical problems that these startups face? Now, why we are discussing all of this is because some of the changes that we will see, or some of the concessions that we will see, have been granted to startups. They are all, or in fact to all the younglings, are all related to attacking all these problems. Lack of financial resources, lack of market access. They don't have proper market access to sell their products. Lack of managerial abilities, meaning lack of skill, lack of training, lack of access to technology and infrastructure, and no level playing field with competition. We are fighting with entities and developed organizations, developed countries across the globe, and there is a definite mismatch in the level playing field with the competition. Also, the laws to a certain extent, are archaic when you compare them with laws in other jurisdictions where your entities would be competing with on a global platform. As we said, one size fits all compliance profile. Now this one size fits all compliance profile is also one of the reasons why the NFRA, as you would have recently seen, is behind the idea of eliminating statutory audits for small entities or small companies. And that research paper obviously is out in the open, and all of us will obviously give comments there, in the sense that why audits are so important, even if that means higher compliance level, considering the way in which Indian corporates operate. So I'm sure those representations will go, and those may or may not be considered. But definitely there is a problem with one size fits all kind of legal provisions for younglings. Now we all know that the last point, I'm not getting into it. The tax websites again hindering a lot of, I mean tax is just one of the examples, but a lot of government infrastructure kind of being slow and lethargic, not being able to cope up with the speed at which these younglings want to grow. Now, what are the kinds of younglings we have? We have private limited companies, we have startups, we have small and medium-sized companies as defined, for the accounting standards. We have the SMEs, again defined for the institute's accounting standards, which are for non-company entities. Small-scale industries under the Small Scale Industries Act. MSMEs under the MSME Act. Small company under the company law. and small LLPs now under the LLP law. So let's see where we are in terms of the accounting standards. All of us might have gone through this, and some of this may be a repetition of what we have already, of what we already know. But I will still touch upon this and not get into too much of a detail into the accounting standard exemptions, because there are no significant changes in the recent time. It's just that these are available to accounting entities since many years. Now, obviously, from a accounting framework perspective, we have Ind AS and the normal Indian accounting standards, and we will go by the leg of Indian accounting standards, not the Ind AS, but the ordinary accounting standards. Now, the applicability of the ordinary accounting standards are broken down into SMCs and non-SMCs, so small and medium-sized companies and non-small and medium-sized companies. So we will see on the next slide how small and medium-sized companies are defined, and the first limb of this whole chart is for companies. On the second limb is non-company, and that the institute's accounting standards still govern those non-company entities in terms of level 1, level 2, level 3, and level 4. Now, how is small and medium-sized company defined under the accounting standards that are notified under the company law? I think some of us would know that in 2021, the accounting standard rules have again been notified. Originally, we were working on the 2006 accounting standard rules. In 2021, the accounting standard rules have again been notified, essentially re-notifying some of the old standards which were already in force. But now with the NFRA coming in, they were formally notified in 2021. Now, what are small and medium-sized companies? From an accounting standard exemption point of view, entities whose debt or equity instruments are not listed or are not in a process of being listed. Insurance, banking, financial, which are not in banking, financial institutions or insurance companies. Companies with turnover other than other income which does not exceed 250 crores. Borrowings in excess of 50 crores at any time. And which is not a holding or a subsidiary of a company which is not a SMC. So as long as you fulfill these criteria, you would be a small and medium-sized companies, and therefore would be eligible for certain exemptions, either in terms of disclosure or presentation or recognition measurement under the accounting standards. So say we have some exemptions under accounting standard 15 for small and medium-sized companies. If there are leaves which are not being paid off, which are relaxed application for short-term accumulating compensated absences. So leaves which are not being carried forward but are compensated, which are not vesting in nature, non-vesting in nature, then there are certain disclosure relaxations in relation to them. There are certain relaxations in terms of not having to discount certain contributions that you are required to make under AS 15 more than 12 years after the balance sheet date. So no discounting. Presentation and recognition and measurement related concessions in relation to defined benefit plans. Now, as far as earnings per share standard is concerned, you don't need to disclose the diluted earnings per share if you are a small and medium-sized company. Certain disclosure exemptions under the accounting standard on leases for finance lease and operating lease. Now, we could go into the details of all of this if we have to, but at this moment, I have kind of chosen not to go into the detail because otherwise we would not be able to complete the whole topic. And these are some of the things that have not come up now. They have been in force since many years, and we don't want to kind of focus only on things which we already know. And then in relation to disclosures in relation to provision, movement in provisions and certain other disclosures, there are exemptions for SMC. SMCs can use other than net present value for measuring value in use for testing impairment. So typically for impairment, you would measure the value in use by way of a net present value calculation of whatever returns are expected from that asset. For an SMC, there is an exemption that you could use any other method if you do not want to use the net present value method. Segment reporting, we all know, is now is not mandatory for small and medium-sized companies. Now, if you are a small and medium-sized company and do desire to take the advantage of these relaxations that are given to you, you would have to disclose the fact in the financial statements and the notes to accounts that you are an SMC and that you have taken the relaxation. Now, the Accounting Standard Rules 2021 have given a standard paragraph that you would typically insert in your notes to accounts for accounting period starting from 1st April 2021 onwards. So this is something that maybe may be helpful whenever the accounts are being finalized for the accounting period starting from 1st April 2021 onwards. And if an SMC subsequently becomes a bigger company and comes out of the thresholds that are there for SMC, the previous year numbers need not be restated. That is one of the relaxations again which is available to small and medium-sized companies. In case of new SMCs, I mean, an entity which was a large company and subsequently became an SMC, you need to be an SMC or eligible for 2 consecutive years to be then thereafter qualified as an SMC. And if as an SMC, you have a choice to selectively apply certain relaxations and not apply certain relaxations. In case if you do so, you need to mention the details of the standards for which you have availed the exemption. That is something that you are expected to do while you're preparing your general purpose financial statements. The Accounting Standard 3 cash flow statements not applicable to small company. SC is small company, OPC is 1-person company, and DC is dormant company. Now that was as long as you're a company. Now if you're a non-company, then you come to the institute's accounting standards where you have level 1, level 2, level 3, and level 4 entities. So for level 1 entities, all the accounting standards kind of apply. For level 2 entities, these would be typically level 2 entities would be entities with turnover exceeding 50 crores, but less than 250 crores, and entities having borrowing in excess of 10 crore but less than 50 crore. And if you're a holding or subsidiary entities of any one of the above, and then similarly, level 3 entities and remaining would be the level 4 entities. So these slides will be available to you after the session. So maybe we'll move a little quickly as far as facts are concerned. We could discuss issues wherever there are. For a level 1, level 2, level 4, level 3, level 4 classification, we discussed that for level 1 entity, all standards are applicable. As far as level 2, level 3, and level 4 entities are concerned, Accounting Standard 3 cash flow statement does not apply. You have segment reporting not applicable, AS 17, AS 18 related party transactions not applicable to level 3, level 4. AS 20 earnings per share not applicable to any of the level 2, level 3, level 4 entities. AS 21 not applicable. AS 23 joint ventures not applicable. AS 25 interim financial reporting not applicable. AS 24 not applicable to level 3, level 4 entities, and AS 27 again not applicable, and AS 28 not applicable for level 4 entities. And some of these standards also have disclosure related exemptions for specific disclosures within the standards which are required. Now we are not getting into details and specifics of this because we've all gone through this in the past and we all know that these are available. We would probably again move on a little further. My plan is to try and see if we can cover a lot more on exemptions in relation to the company law, because some of them so many changes have happened under the company law, and some of these need to be refreshed, and some of these are new in nature. Now, again, for the institute's accounting standards, if the small and medium-sized entity, it has to disclose that it is a small and medium-sized entity. It need not restate previous year numbers, same as the Companies Act accounting standards. In case of selective applications, again, you need to disclose, and downward benefit will be available only after 2 consequent years. So same nuances in terms of both the accounting standards. So from a CARO and internal financial control point of view, one-person companies are exempt from both CARO and internal financial control related reporting requirements. Small companies are exempt. We will come to what a small company is as per the present definitions. They have the ministry has increased the thresholds for small companies. Also, 1% companies, certain interesting changes, I believe, are quite far-reaching and could completely change the way in which small and MSMEs operate in the country. Now, private limited company, which is not a subsidiary or holding company of a public company, and which has a paid-up capital and reserves of not more than 1 crore, and which does not have borrowings exceeding 1 crore from bank or financial institution, and which does not have and which does not have a total revenue as disclosed in Schedule 3 exceeding 10 crore. We have a CARO which is exempt for these entities. Again, within private limited companies, there is a small section which is called startups. We'll come to that later. Some nuances around there. As far as internal financial control reporting is concerned, entities which have a turnover of less than 50 crores as per the audited financial statements, or which have an aggregate borrowing from banks and financial institution of less than 25 crores, internal financial control related reporting will be exempt. Now these are all numbers which are there on your screen, and you will be able to individually evaluate, for your respective clients as and when required. Now let's see the kind of so this was on the bit of accounting standard, and now coming to the key area, which is the Companies Act, and what are the benefits and privileges which are available to these younglings under the company law. So we have private limited company, which is one of the younglings under the Companies Act, essentially, which kind of restricts the number of members, restricts transfer, limits transfer, and prohibits a public issue. And then there are IFSC private limited companies, which are kind of set up as a IFSC. Small companies having paid up capital of less than 2 crores and turnover of less than 20 crores. Now, this threshold has been increased significantly, very lately in 2021. And because of this, a lot of companies are now covered under, the threshold of small company. And startup companies, private companies which are recognized in terms of the Department for Promotion of Industry and Internal Trade, those will be recognized as treated as startup companies. So there is a concept of startup companies also introduced under the company law. So earlier we couldn't find words like startup company under the company law, but now the company law uses words like startup companies. Even the income tax now uses words like startup company. Then we have 1-person company, which means a company which has only 1 person as a member, and a dormant company, not used quite often, but an interesting vehicle, inactive company, or a company formed for a future project or to hold an asset or intellectual property and has no significant accounting transaction. And MSME, this is the MSME concept under the Companies Act, under the MSME Act, sorry. So what are the key relaxations applicable to private limited companies under the company law? Under the related party transactions, requirement under section 188 of the company law. For a private limited company, a majority of minority approval is not required. So let's be careful. There's sometimes a misconception that section 188 does not apply to private limited companies. That's not the case. Section 188 does apply to private limited companies, but a majority of minority approval is not required in case of a private limited company, meaning thereby a member who is a related party is entitled to vote in a shareholder resolution in case of a related party transaction. Now, even the definition of related party under 2 subsection 76 of the Companies Act has certain exemptions for private limited companies. So a holding subsidiary or an associate company is not treated as a related party for a private limited company under the Companies Act. Now, this is a change which generally is overlooked many a times when we are dealing with related party transactions, that for a private limited company, a holding company, subsidiary company, or associate company is not a related party as defined under the company law. So for related party transaction under section 188, maybe you could take that view that it is not a related party since it has been excluded under 276(8) for a private limited company. Now, the company law requires companies to have a written contract with their managing director and preserve the same at the registered office of the company. Now, for a private limited company, this requirement is not applicable. So you could not have a written contract as well with your managing director, and you're also not required to preserve the same at the registered office. Dematerialization of shares is something that is optional. There's no requirement for closure of register of members and debenture holders. Typically, when a corporate action is being taken place at the company. Postal ballot and e-voting facility not required. That is another exemption that is available. Independent directors and women directors, again, excluded from private limited companies, have been excluded from the requirement. Rotation of directors is not applicable. Audit committee and nomination and remuneration committee are not required in a private limited company. There's no need to file a commencement certificate. There's no ceiling on the managerial remuneration. Managing director, whole-time director, contract is not open for inspection. So again, you could pay how much ever you want to. That kind of flexibility is there and available to private limited companies. You don't need to necessarily have a key managerial personnel other than a company secretary. There's no secretarial audit requirement under the company law. Now, there's an ability to call a general meeting with a lesser notice period. You could call it whenever you want to by obtaining consent of the shareholders. Accepting deposit from members up to 100% of paid up capital and free reserves is permitted in case of private limited companies. Certain private limited companies are exempt from reporting on internal financial control systems in relation to financial statements. Section 180, which essentially deals with obtaining shareholders' resolutions when you are borrowing above a threshold or where you are disposing of a particular undertaking of the company, is not applicable in case of a private limited company. A lot of resolutions which typically require filing in a public limited company or a non-private company are particularly section 179(3). Some of us would recall that when the Companies Act started, a lot of MGT 14s were required to be filed because of various resolutions passed under section 179(3). 179.3 essentially, deals with certain matters which are kind of to be decided only at the board meetings, whether to lend money, whether to borrow money, etc., etc. And for that, we used to file MGT 14. Now that requirement has been done away with. In a private limited company, there is a possibility that you could pass a single resolution for all directors' appointment. So you need not have separate resolutions for each and every director's appointment. Typically, for a public limited company, that requirement is there. You'll have a single resolution, need not have multiple resolutions. Now, this is one very interesting thing is, the explanatory statement. Typically, we have explanatory statements attached to the notices for general meetings. Now, for a private limited company, there is flexibility that in case if you amend your articles and omit this requirement of an explanatory statement, then you could have your meetings even without with notices without having explanatory statement. Now, this is one, I believe, underutilized exemption prevailing amongst the entities or companies that typically operate in the Indian market, and for which all of us would probably agree to this. Maybe this is something that can be explored, that once and for all, whenever you are next amending the Articles of Association, is there a possibility that you could amend the requirement to have an explanatory statement whenever a matter is sent to a shareholder for approval? Differential rights share. So for a private limited company is entitled to issue shares with differential rights as to voting or dividend. So you could have Class A shares, Class B shares, Class C shares with differential rights as to voting or dividend. Now, this again is another underutilized privilege which has been granted to private limited companies, whereas the startups have started using this, but a lot of traditional organizations still have not fully adopted the usage of differential voting rights. And in jurisdictions outside India, this is a very preferred tool for retaining control by promoters, at the same time attracting investors to maximize the value for investors as well as for the promoters. Now, for private limited companies, the rights issue typically, Section 62 requires a minimum offer period of 15 days. For a private limited company, you could get an exemption for it if 90% of your shareholders consent to it. ESOPs can be issued by way of an ordinary resolution. You need not pass a special resolution if you need to issue ESOPs in case of a private limited company. Another very important point typically missed out while structuring transactions, etc., is purchase of own shares for the company. Now, we all know there is a restriction typically under company law that a company cannot buy its own shares. But for a private limited company, there is an exemption under this section, which means technically that company could finance or give a loan to someone else to purchase its own shares. Now, this again is a provision which is not very well publicized, or not always all professionals are aware about. I thought it will be good to discuss that as well today. The limit on 20 company per auditor is not applicable if a private limited company with paid up capital less than 100 crores. The directors, I think we discussed this point, it's a repetition. Directors not required to retire by rotation. Typically, if you want a person to be appointed as a director, there is a requirement to give a 1 lakh check for a director to then be able to put his name for appointment. That 1 lakh deposit is not required for private limited companies. Additional disqualifications other than those in section 164 can also be provided for. Now, this again is a very important structuring tool, not often seen being used by companies. Is by your articles you could have additional conditions for disqualification of directors who are a part of your company. So you could, apart from whatever is provided under section 164, you could have 10 other conditions wherein anyone who is appointed in your company, if he or she suffers from those disqualification, the law itself will allow you to remove that director. Another important point, interested directors. If there is a resolution where an interested director is present, the law required that that director should be excluded from the count of quorum. But for a private limited company, he can be counted for quorum and he can also vote in that resolution. Earlier, we had a lot of trouble with this provision being in place because a lot of closely held companies not being able to function the way they were originally functioning under the old company law. But later on, the government gave these relaxations, I think a couple of years ago. Directors loan, so section 185. So what happened is originally we had section 185, which restricted loans being given by a company to directors. Now this section 185, thereafter there were certain exemptions that were given for private limited companies. Essentially, if it's a company where only individuals are holding shares in the company and the borrowing is less than 2:1 or 50 crore, whichever is lower, then that company could have given a loan to its directors. Now that exemption came in. However, thereafter section 185 was amended, essentially enabling any company by passing a special resolution and by mentioning the purpose for which it is used to allow loan being given by the company to another company in which a director is interested. But the current provision of section 185 still restricts the ability of a company to give loan to an individual director. Now, the typical question comes is whether the exemption that was granted under the old section of the 185 will still continue to apply under the new section of 185 as has been replaced. Now, the answer is it should, but I'm not sure many are fully aware of the existence of this provision and the interpretation of it. So now coming to one-person company, I was saying there's one very important change in one-person company. We all know the other change, there's only one person, so you need not have meetings, etc. But earlier there was a threshold above which, and the threshold was very low, above which a one-person company had to compulsorily convert into a private limited or a public limited company. So we will take this question at the end, the question that has come up. So the conversion, so originally it was necessary that the company had to be converted into a private limited company. Now that requirement has been removed, which means that a one-person company could be as big as it wants to be, and there is no restriction under law that this is the maximum size of a one-person company. And an existing private limited company is permitted to be converted into a one-person company. So I was thinking aloud as to how, as a profession, we should respond to this NFRA consultation paper that has come out, essentially claiming that for private limited companies of a smaller size, there is no public interest involved, and therefore there is no need for an audit because there are no external interests which are involved. Maybe one of the arguments to take, and I'm just placing it as a thought, for whoever is probably interested in putting this whole thing down, is so if So first of all, it's important to understand why an entrepreneur sets up a private limited company in India. He has multiple avenues. He has a partnership firm which he could set up. He could set up a proprietorship firm. He could set up a limited liability partnership firm. And limited liability partnership firm is the most preferred form if he wants limited liability. Now, why would he sometimes choose to have a private limited company or a limited liability partnership is when he would want a difference between ownership and management, right? In a private limited company, we can achieve that. There's a difference between ownership and management, which means that if the management intends to have shareholders who are different than the management, that's when typically one would go for a private limited company. So you would have investors, you would have lenders, or you would prepare to have that, okay, if 2 years down the line, 3 years down the line, you want to have lenders or you want to have investors in the company. That's when actually you go to set up a private limited company. So therefore, to say that there is no public interest involved in smaller private limited companies is not correct, because all of them intend to have third parties in the company, either as shareholders or as partners or as directors or in some other way. Because if they did not want that, they have an option now under law to convert into a one-person company. So if they really want, so if you really want to exclude, then exclude one-person companies outside of the domain of statutory audit, but do not exclude private limited companies, because a person who is having a private limited company and who is not choosing to have a one-person company, the only reason he's doing so is because he needs two shareholders. Otherwise, he would have converted, or he's expecting to have two shareholders. Now, an argument could be made by NFRA that, okay, it is husband and wife who are two shareholders in the company. That's why he is standing in the private limited company. No, he could have made an LLP in that case. The prime reason to set up a company is that ownership and management need to be different. So whichever private limited companies the NFRA has listed down in the consultation paper, let those private limited companies who do not want statutory audit convert into one-person company, for example, if that has to be the case. So that is one interesting argument that is available, considering these recent changes, which NFRA has not factored in the consultation paper. And obviously it should go as in by way of suggestions from the institute or whichever societies are kind of going to give the representations, and maybe even at the study circle, I'm not sure whether we could get together as a group and do that. But these are some valid points which will need to be raised. But keeping the NFRA aside, this is a very interesting way, and a lot of the companies that you may be advising would prefer to convert themselves into a one-person company, particularly now that there is no limit on the size and you could grow as much as you want to as a one-person company. Yeah, just a moment. The screen has hung, so I'm just trying to see. Yeah. So earlier there was a requirement of paid up capital of 50 lakh and annual average turnover of 2 crore. You required compulsory conversion to a private limited company. Now that's not the case. So people typically did not set up one-person company because they thought, we will grow beyond this soon, and then we have to again convert to private limited. Then might as well just directly make a private limited company. So now, with this change, a significant change should happen in the number of private limited companies, particularly, if it is looked at from the context in which I was referring to as far as the NFRA consultation paper is also going. Now, we all know one-person company provisions on meetings do not apply. Benefits available to small companies to be available to one-person companies subject to size. So all the benefits available to small companies will apply. We'll see some of the benefits that are available to small companies as well. Now let's see what's a small company now, and what are the benefits available to small company. And some of us may have a lot of clients who are small companies who could possibly be out of the audit ambit if the NFRA has its way. But But what are the benefits for a small company? There is an abridged annual report. There is a short form annual report that you need to prepare as a small company. There are lesser penalties that are available for small company in cases of default. Lower ROC fees. You can have only two board. I mean, you could choose to have only two board meetings in a year instead of 4, which is typically required for any other private limited company, which is not a small company. Merger of two small companies are possible under the short form merger route, which is with the RD approval, and you need not go to the NCLT if there is a merger of two small companies which is being contemplated. Abridged director's report, a shorter director's report along with the annual report. We saw that accounting standard 3 cash flow is not applicable, CARO is not applicable. And there's a simple format of the annual return, which is the MGT 7A. Certification requirement from professionals for various ROC forms is not applicable for 1% company, startups, and small company. So there's a difference between startup and small company. So a company could be a startup, but not a small company as well. So that distinction we will see, because a startup is whatever entity is recognized by the Department of Policy, Promotion of Internal Trade, Industry and Internal Trade, and a small company is defined by the numbers. Now coming to startup company. So startup companies, we have certain relaxations to startup companies under company law, particularly if if you see point 2, the maximum limit in respect of deposits to be accepted from members shall not apply to startup for 10 years from the date of incorporation. 100% of paid up capital and free reserve, the limits that are there will not be applicable for 10 years for startups from the date of incorporation. Lesser penalties again, short form merger again for startup companies and small companies. Startups can issue sweat equity shares up 50% of the paid up capital up to 10 years from the date of its incorporation. We all know the Sunanda Pushkar matter, where sweat equity shares were issued, and because of that a lot of controversy was created. At that point of time, issuing sweat equity shares within 1 year of incorporation was not permissible. Now startups have been permitted to issue sweat equity shares up to 50% of their capital for the first 10 years from the date of incorporation. ESOPs can be given, obviously, so I think that's not a material point. Again, only two board meetings, even if it is a large private limited company. So this is one controversial point, or maybe a little nuance, that if you are a startup company and you say you continue to be a startup company for a certain number of years, once you're a startup company and if you become a big company, under company law, you may still be treated as a startup company, and therefore only 2 meetings may be required. Even if you exceed the threshold of being a small company under the company. So that is something that is an advantage which we can try and kind of get if we are a registered startup under the DPIIT recognition norms. Now the DPIIT recognition norms again are a little tricky there, in the sense that you don't necessarily get an exemption under income tax, a deduction under income tax, if you are simply registered with the DPIIT. You also need to get a recognition from the interministerial board. And from what I understood is there are only around less than 500 startups which have been kind of given the deductions or the benefits under income tax for the first 3 years of profit in the given period of 10 years. So lesser number of startups being given income tax deduction, very, very selective in that sense. But a lot of startups registered with the DPIIT for other benefits, which could include angel tax, etc., etc. Now, startups have been given the benefit of self-certification for compliance with various labor laws, Provident Fund, ESIC, and a lot of industrial laws as well. They could do self-certify themselves. No inspections will be conducted for startups for the first 5 years. So if your client is starting a new business, there is no question that you would not ask him to register as a startup. If he qualifies to be registered as a startup, you would definitely ask him to be registered as a startup. So, fast tracking of startup patent applications, a panel of facilitators to assist in filing of IP applications. One area where the government thought as a country or as in entrepreneurs in the country were kind of behind in terms of the size that we are was in terms of the patent filings. So a lot of assistance and support is now being provided for startups for making patent applications in India and even outside. Concessions in filing cost, because the biggest hurdle for patent filing for startups was the cost of filing. Even if they did an invention, the cost itself was so high. So the concessions have been granted in terms of cost of filing of patents, and also know-how. A lot of people don't know how to draft patents, file patents, do things. A lot of scope there in terms of improvements. So the government is trying to improve the whole ecosystem around the patents and intellectual property. Now, these eligible startups, are kind of exempted from paying tax for 3 consecutive financial years out of their first 10 years. This is what I was talking of, the small list of 300 to 500 entities which have been kind of approved. They have the deduction under 80ISE that is available to them. But after the interministerial board approval, which looks at very critically on the proposal that you have. 56 to 7B, the angel tax exemption is available for startups. So that is something that was a much needed relaxation or benefit. Again, we are going a little bit on the income tax side, but this is one of the important benefits for startups. Some of the startups, the DPIT recognized startups have been, exempted from EMD and bid security while filing government tenders, which means that, you could get an edge in terms of bidding in tenders by not being out of pocket and still being able to participate in the tender. The government also on its end has been kind of following up with all the central public sector undertakings to kind of measure to what extent they procure their requirements from MSME sector, and has been regularly tracking them and has made a lot of dashboards to kind of make the necessary bureaucrats responsible, or at least have visibility or whether there is action being taken in terms of supporting MSMEs or not. So a lot of emphasis being given to startups, to MSMEs, basically to all younglings, to kind of being able to grow. Now how does the law define MSMEs? So original definition was in lakhs for micro entities and smaller thresholds, but with this COVID-19 and subsequent changes, there have been sweeping changes in terms of the definition of the MSME. So investment of 1 crore and turnover of less than 5 crore would be a micro MSME. So a lot of small and medium accounting firms would probably fall under micro if they don't own a lot of plant and machinery. Then small investment of less than 10 crores and turnover of less than 50 crores and medium sized, which is now 50 crores of investment and 250 crores of turnover. So the medium is a significant number. So thereby a lot of entities have been covered under the ambit of MSME and are therefore entitled to various benefits under the MSME law and related laws. So how would the plant and machinery, be calculated? Uh, it's linked to the income tax return and the plant and machinery as per your tax return. The income tax does have an MOU with the MSME ministry to kind of exchange information in relation to plant and machinery sizes. Now it is other than land and building and furniture and fitting. So plant and machinery definition will be, as per the income tax rules. And then whether it is, the gross value or a net WDV value, that was one question which kept on coming. So we have clarity now that the values are the tax net WDV values, which will be treated as values of plant and machinery for the purpose of evaluating whether a particular entity falls under micro, small, medium, or large. Turnover for the purpose of export of goods or services shall be excluded while calculating the turnover. So even if the size of the turnover is more than the thresholds, even in that case, an entity could continue to be an MSME if it excludes the exports from that calculation, and which the entity is entitled to do. Now, once you are an MSME, if there is an upward change in terms of investment in plant and machinery or turnover or both, and thereby a reclassification is required, then you will maintain that status for at least for the 1 year from the close of the year of registration, basically. Thereafter, it will change immediately once you increase the threshold, once you go above the threshold. Now, if you are a large company and subsequently you become an MSME because of various reasons, then the enterprise will continue in its present category till the closure of the financial year, and it will be given the benefit of change status only with effect of 1st April of the financial year following the year in which the change took place. You have to wait for the whole financial year, and thereafter only you can proceed. Now, an old notification of the government kind of excludes, under the MSME Act, excludes certain items to be included from the definition of equipment. Installation cost, pollution control equipment, power generation set. So some of these things will have to be excluded from the definition of plant and machinery, and that will have to be evaluated on a case-by-case basis whether the thresholds are being met. Now, how seamlessly that works with the income tax giving the data, I'm not very sure on that, but I think from a point of view of the company, you will have to individually assess on a case-by-case basis whether it is possible to exclude or include a particular item which could be treated as an equipment or plant and machinery, basically. Now, some businesses are expressly clarified as not being eligible for MSME registration. So some of which are, the forestry and logging, fishing and aquaculture, wholesale and retail trade and repair of motor vehicles and motorcycles, wholesale trade except of motor vehicles and motorcycles, retail trade, activities of household as employees for domestic personnel, undifferentiated goods and services, producing activities of private household for own use, activities of extra-territorial organization and bodies. So some of these will not be eligible for MSME registration. And again, if you're a holding or subsidiary company of any of those, then also the same conditions apply. Now, so a lot of privileges are otherwise available to private or MSMEs. A lot of more than 30 support schemes. If you go through each scheme, you will find that the government is doing a lot of efforts. At least it appears so on paper in terms of the number of schemes that are being launched for supporting MSMEs, and some of these. I believe not all MSMEs are aware of all these benefits that are available And I think as chartered accountants and as professionals, it would be our duty to kind of bring this to the notice of the relevant clients, if in case some of it benefits to some of our clients, just to assist the government in in its policy of making the MSME grow. Recovery protection. So we have the Samadhan portal. Essentially, MSMEs could file a complaint with the Samadhan portal if their dues are not paid in due course within the 45-day period that is being given. But if you go to the Samadhan portal, you will realize that thousands of complaints are pending. So what has happened is, again, a good and well thought out law, but without supporting implementation machinery, like we have seen in many laws that have been implemented in the past. Nevertheless, we hope that at least that the law has been passed. Maybe going forward, the machinery and the infrastructure would also be in place. From an RBI perspective, MSMEs are classified under the priority sector lending master direction, which means that banks have to fulfill a certain priority sector lending norms. They would always prefer to lend to MSMEs over others if their targets are not being met in terms of lending to MSMEs. Interest subvention, MSMEs are allowed for an interest subvention, essentially meaning that if they have to approach their banks and claim that they are an MSME and they are eligible for the interest subvention, and therefore their interest should be reduced by 2%, 1%, depending on the eligibility. And their banks will reduce it for them, because for the banks, they get the money from the government. So it's not that they lose the money. So the banks are also inclined and willing to support for interest subvention schemes. Trade receivables, discounting system, which is again an online portal which is available. Now this portal we will discuss in one of the slides in a little bit more detail. There are plans to link it to the GST portal as well going forward. For RBI, from a banks and financial institutions perspective, for MSMEs, there is a liberalized provisioning norms and debt restructuring provisions which have been facilitated by the RBI. So that's what the RBI has been kind of doing. The MCA on its part is kind of requiring mandatory reporting of MSME dues, disclosure in the accounts of all companies, concessions in terms of non-application of cost accounting records for MSMEs. The Insolvency and Bankruptcy Code, providing for various provisions to support MSMEs, allowing them to bid if they were MSMEs of a company which kind of turned NPA. Again, the recent prepackaged insolvency resolution framework provides for MSMEs to kind of retain control of their entities by moving to a debtor in control model as compared to the present IBC creditor in control model, to kind of allow the promoters of the MSME to retain control of the company, at the same time cleaning off all their outstanding dues and also maximizing the value for the lenders. Then we have tax related benefits and exemptions being given by the Ministry of Finance, Atmanirbhar Bharat. From a state government perspective, also various state governments have differing incentives which are being granted for investing or for various concessions that they are granting to MSME. So from all sides, there are privileges being granted to MSMEs. How far these privileges are reaching the individual MSMEs is something that is not very clear. And I believe if all of us on this Zoom call say were not aware of all of these provisions, or at least some of these provisions or privileges, then I'm sure the MSMEs for sure would not be available of those benefits and privileges. Because as I said, as a chartered accountant, the chartered accountant entity or the firm itself is also an MSME who is eligible for all these benefits. And therefore, you could understand what could be the situation of our clients who kind of don't necessarily read all these laws or attend all these webinars as we are presently doing. So if you see the number of schemes that have been launched for MSME, more than 30 schemes for MSMEs. Details of all these schemes are kind of available on the MSME website. Sector specific schemes, generic schemes, marketing assistance. So all the troubles that we originally discussed, which are kind of being faced by MSMEs, they are all attempted to be kind of redressed by these various schemes. Now, it doesn't necessarily mean that having so many number of schemes percolates down to benefits, but at least it is one positive step that at least from a messaging perspective or from the MSME feeling that they are being supported, that at least is being achieved. Now, obviously, there is no exact way to measure the benefit of all these schemes, but I'm sure some of the benefits, if not all of the intended benefits, will be percolating down to the MSMEs. So some particularly important are the credit guarantee trust fund for MSMEs, where the government gives a guarantee for borrowing that an MSME is doing, or credit linked capital subsidy for technological upgradation. So some of these are interesting schemes which could be useful in for multiple smaller clients that we may have, at least MSME clients that we may have. So I think I'll take the question that was there in between. On a private limited company is 100% subsidiary of listed entity. Limit of 20 audit will be applicable to auditor of private limited company. So yes, so that will be treated as a public limited company for all practical purposes under company law, and therefore that will be counted within the limit of the 20 audits. That's what I would opine on. Okay, so we will move on. As of now, there are no further questions that have come. So now let's see for MSMEs, the most important provisions as people see it is the condition wherein a person dealing with an MSME or a company dealing with an MSME is required to make payment before 45 days to that MSME. Now, what is the provision? The provision is that the buyer shall make payment before the date agreed upon between him and the supplier in writing or the appointed date. So you could have two things. You could agree to a 7-day period with your supplier, and then you have to pay within 7 days. Or if no period is agreed, in any case, you need to pay within 45 days. Now, what is appointed date? Appointed date means the day following immediately after the expiry of 15 days from the day of acceptance or the day of deemed acceptance. So the day of acceptance is equal to the delivery date, or if objection is raised upon the removal of the objection. So from the delivery date, from the day of acceptance. 15 days from the day of acceptance is the appointed date. So either you agree to a date or you pay by the appointed date, which is 15 days. In no case can this total period be more than 45 days. So if no objection is raised, then 15 days after the acceptance day will be treated as the day of deemed acceptance. So without getting into the technicalities of this, in sum and substance, within 45 days, the payment has to be received by the MSME entity from a company with which, a large company with which it is dealing with. Now, if that is not done, the law says that the buyer shall be liable to pay a compound interest with monthly rests to the supplier on that amount from the appointed date, or as the case may be, from the date immediately following the date agreed upon, at 3 times of the bank rate notified by the Reserve Bank. So this is a significant supporting provision for an MSME. Now, obviously, there are practical considerations on the ground. When an MSME takes this step, it has to consider that what about the future relations? What about whether this person will continue doing business with me or not? So those after having regard to those, if an MSME does file a complaint on the Samadhan portal, then ultimately it takes a lot of time, in the sense that the present pendencies are quite huge, but ultimately the MSME under law will be entitled to receive this amount from its customer. So that itself is a single most important benefit that is available to MSMEs who have registered under the MSME law. Now, how is this supported in terms of the regulatory provisions under the MSME Act? It says notwithstanding anything contained in any other law for the time being. So it says a non-obstant clause. So if a party, any party to a dispute may, so it's an option, with regard to an amount due, make a reference to the MSME council. So there's an MSME council which will kind of resolve after you file the complaint on the e-Samadhan portal. Now, reference has to be made within a period of 90 days from the decision has to be made within a period of 90 days from the date of making such a reference, but it doesn't happen. Like many judicial forums, this may not necessarily be a complete judicial forum, but it doesn't happen in that time. But then again, there are various judgments which say that these timelines are direct. You cannot force upon the you cannot force upon the companies, upon the judicial forums, the timeline by law. Now, almost all states, have notified councils and have constituted council as per the MSME Act. Now, where does the complaint have to be filed? The complaint has to be filed in the jurisdiction of the supplier. So wherever is the location of the supplier, that is the place, council which will be entitled to deal with disposing of the reference. Now, most important protection here is that once you get a favorable order from this MSME Facilitation Council, then an appeal is not possible unless the buyer has deposited 75% of the amount. So that is a significant deterrent. Amount means amount including interest. So that is a significant deterrent for anyone to not pay this, because if they have to pay the amount and then go and appeal, and it's a straightforward law, you sell the goods, you take delivery, you don't raise objections, you are supposed to pay within the given number of days and time, otherwise interest starts. A simple mathematical calculation. So a significant supporting provision here. as we said, the Samadhan MSME portal. Whether the silence of the buyer after physical receipt of goods can make a claim ineligible for admission by the council. So the MSME website has FAQs wherein they have kind of said that if the buyer has problem, he has to object within 15 days. So if any of your clients is on the buyer side, you would typically want him to say that, okay, please immediately raise an objection. Otherwise, it will be a deemed date of acceptance, and therefore 15 days from that date will start, which effectively means that the MSME will be entitled to payment. Now you could subsequently go in appeal, etc. But then, that's a long drawn process, and you have to deposit 75% if you want to go in. The next is whether a legal notice is a prerequisite prior to filing a reference with the eSamadhan portal. The answer is no. A legal notice is not a prerequisite prior to filing. So I will try and see if I can take many case. MSME has not discharged its GST liability or filed required GST return, and because of that, the party is not able to get the credit of the GST amount. Hence, party wants to withhold the GST amount and will pay post he gets the credit, which may exceed 45 days. In such case, reporting is required. Interesting question. So I think the GST law does not necessarily allow you to withhold payments until you don't get credit. Now, my view would be that this is still a liability that needs to be paid, and withholding beyond 45 days would be a violation of the MSME provisions and would require reporting as is applicable for those entities. Now, practically, there may be different ways to manage that or handle that, which probably we cannot discuss at this forum right now completely in detail. But prima facie, this seems to be my view, Virendraji. So if a person is not registered at the time of default made by the company, but later on person gets registered, can he take benefit of the MSME scheme for recovery considering the intent of the scheme? The answer is no, because the person with whom you are dealing with was not aware that you are an MSME entity. So there's no way that the customer would come to know that you are an MSME entity, and therefore the payment needs to be made within the timeline within which it needs to be paid. If the same or related subject matter is under another court proceeding, then whether a claim is admissible in the council. So what the MSME FAQ has clarified that no, you have to choose. If you're going to another court, then it will not be admissible under the MSME council. Then the court will ultimately decide. But under IBC, some people have been taking a differing view, because IBC is not a proceeding for recovery of dues. IBC essentially is a process for resolution of corporate debtor. So the verdict is kind of not yet out, in the sense, how would the MSME deal with a case where an application before IBC has been filed. The NCLT does not take cognizance of the MSME interest to make the amount reach to the threshold if an MSME application has already been filed, and there are some judicial precedents to that effect. So some other benefits for MSMEs. CDB is giving loan and equity investment in MSMEs by way of online application. This credit guarantee scheme that we were talking of, loans up to 2 crore without collateral and third party guarantee. Interest subvention scheme up to 2% on fresh and incremental loans, maximum up to 1 crore. I mean, this interest subvention scheme is applicable even for chartered accountants who have facilities which they have availed from their financial institution. So maybe it could even be relevant to chartered accountants who have some borrowings and are using it for their business. So we've seen some chartered accountants take benefit of this credit-linked capital subsidy scheme. 15% subsidy on institutional credit up to 1 crore. So I mean, we could get into detail of all these schemes, but we don't have enough time of go into detail, and neither is the subject on this today. We could have a separate session, maybe some other day, specifically going into nuances of each if required, or otherwise these are self-explanatory, benefits which are available and also on the website of MSME. Intellectual property and international marketing. So, 50% subsidy for patent registrations we discussed. Reimbursement of certain participation costs in international trade fairs. Now, this is also some of the benefits that are available to MSME entities. Now, earlier we discussed, about this TREADS platform, and I said we will have a separate slide to discuss this. So this is a very interesting concept, and the plan is to link the GST also to this, and also the government e-procurement portal to this, e-marketplace to this. So basically all central public sector enterprises and companies above a certain threshold have been mandated to register under the TREADS portal, which means that they are suppliers who upload invoices on the TREADS portal, and these entities would go and approve, that this is a valid invoice that has come to them, and that approval, and this is built on blockchain. This is a real life application of blockchain technology. So you raise an invoice. The supplier raises an invoice. The customer, who is a bigger entity, confirms that this invoice has been raised and I have to pay it in say 60 days, and it becomes a factoring unit. Which is kind of blockchain. So it's identified. This is the factoring unit. So no personal information are given to everyone. But then there are all NBFCs are allowed to provide a loan by taking over the factoring unit on a no recourse basis. So from a small supplier point of view, it's a without recourse receivable discounting. So you have a receivable of 100, for example, you discount it and say you get 95 out of it, and you take it and that's yours. You don't have to return it back ever, and the risk is taken by the NBFC. In fact, this year, 2021, the Rajya Sabha has passed the factoring amendment bill, making or enabling all NBFCs in India to be able to lend over the TREADS portal by way of factoring. So that's again a significant initiative that is being taken by the government. There is unsecured financing that is available to the MSME through this portal. In the sense, it's not completely unsecured. You are hypothecating your receivable, but yes, no other security apart from it. It's completely electronic process. For corporates, they save on certain procurement costs. They get immediate, discounted supplies basically. They can manage their working capital better. There's no borrowing that's reflected in their books. From a lender's perspective, they are able to achieve their priority sector lending targets. They are able to get security profiles of the MSME borrower based on whatever past transactions they've had. And they're able to also reduce their operational cost by lending online. So there are certain TREADS platforms which have been there, Receivables Exchange of India, etc. So this is going to be a thing which may pick up well if this is linked with all the other initiatives of GST and then the e-marketing portal, etc. Now this is the pre-packaged insolvency resolution process related benefits that are available. I will not go into detail of prepackaged insolvency resolution process, but in summary, I will just explain for the listeners here today. Essentially, the problem that the government saw with the CIRP process. So this is PIRP. The CIRP is a corporate insolvency resolution process, which is presently being followed. Was that a lot of MSMEs were either going into liquidation, or they were not being able to fetch proper valuations because the promoter was everything in that entity. And even, these MSMEs who were kind of going through a difficult scenarios lost everything that they had. So the reason why this was happening was because you had an IRP who probably was a professional, but not necessarily, a businessman who could run the company in a way in which an Indian promoter would typically run the company for various reasons. So what the government has now come out and said is that, okay, for MSME companies there could be something like a pre-packaged insolvency resolution process, in the sense the promoter knows that, okay, the company has defaulted or is in the process of defaulting. So the promoter himself prepares the resolution plan and agrees the same with the lenders that, okay, this is the resolution plan, and they also agree to a buffer that, okay, I am saying I will give you 100 rupees for resolving this entity, and this is how it will be done, etc., etc. So if some bidder comes with a more than 10% buffer, then the lenders are free to give to that third party. But if some bidder comes, say I have bid for 100 and he comes for 107, and there's a 10% buffer which I had agreed with the lenders, then I would have a right to match that 107 and come to 107. So the idea, and this is just a short brief of the pre-packaged insolvency resolution process. The idea is to kind of allow the promoters of the MSME company to retain control of the company. So that's the kind of initiatives that have been taken. Again, we already had Section 29A even for CIRP, where promoters of MSME companies, if they were registered as MSMEs, were allowed to bid for their companies, even if they would have been NPAs in the past. So then under the LLP Act also, now we have the concept of small LLP and startup LLP that has been introduced by way of the amendment in 2021. So we have where the contribution does not exceed 25 lakh and where the turnover does not exceed 40 lakhs. Those are small LLPs. And a maximum it can be notified up to 5 crores by the government for the contribution, and up to 50 crores for the turnover by the government. So as of now, the benefits are very limited in the sense that you have to pay lower penalties and lower filing charges, etc. But gradually this may also be one avenue which the government would kind of look to kind of bring them into the ambit of the MSMEs. Startup LLPs, again, those notified by DPIIT would be also startup LLPs. So these new concepts are now being brought in, and specific focus to smaller entities is kind of being placed now in this new regime. So penalty for non-compliance of any provisions of this act by small LLP or startup LLP or its partner or designated partner, then such LLP or its partner or designated partner shall be liable to penalty which shall be half of the penalty specified in the provision, subject to a maximum of 1 lakh rupees and 50,000 rupees for every partner. So 100 rupee per day, used to become lakhs for so many entities, and then they never complied with it because never ever they wanted to pay that much amount to do their filings. So that is kind of being sought to be addressed over here by trying to put a cap to overall fees. Now we are kind of coming to the end of our session. But I thought two slides maybe we could cover on this NFRA and how the NFRA is kind of looking at assisting small and medium-sized companies in reducing the burden of compliance. So the ICAI, as we all know, has come out with an approach paper on revised accounting standards, which kind of are a little bit more towards the IFRS, but will be followed by all other entities. And some of the standards are already out in the public domain for comments, and some are still being formulated. Now, there was a response recently that NFRA gave to ICAI, and I'm just reading it aloud. What the NFRA is kind of thinking about this revision in accounting standards. Now, NFRA noted that most of the companies to which revised accounting standards will apply are private limited companies. So many of the companies are very small net worth or turnover or indebtedness or combined. And they would be mostly owned by small families, sometimes along with small circle of friends and relatives. Therefore, public interest in the general purpose financial statements of these companies would most likely be minimal. There are a number of revised accounting standards that are very large and complex and may not be relevant and useful to the limited users of the general purpose financial statements of these companies. The expected standard cost to perform a reasonably good quality audit performed in compliance with the letter and spirit of the standards on auditing is significantly more than the presently reported audit-free ranges. That is a very large percentage of accounting standard companies have reported payment to auditors of less than 25,000. So these are, this is the outlook of NFRA, essentially saying that don't have this revised auditing accounting standards being implemented. Now, in the NFRA report that came out a few days ago, I believe this week itself, what the NFRA has done is they have compared various global jurisdictions and evaluated those global jurisdictions to see that what is the requirement or condition of audit in these jurisdictions and to which entities it is mandatory. So some of the countries on your screen are, this is an extract from the NFRA report where they are kind of saying is like, if you see a country like Austria, they would have a 5 million euro of balance sheet size, minimum 5 million euro of balance sheet size, or turnover of 10 million euros, or employee minimum 50 employees. So if 2 out of these 3 conditions are fulfilled, only then an audit is mandatory in a country like Austria. And all of these European countries are kind of driven by the EU directives that are issued to these respective countries, and then they have the right to form their individual thresholds. But predominantly, there is a balance sheet threshold, there is a turnover threshold, there is a threshold, and 2 out of the 3 have to be fulfilled. Only then a mandatory audit is required in these jurisdictions. So essentially, FRA is trying to drive a point that small and medium-sized companies in India kind of need to be relieved of the compliance obligation for statutory audit, compulsory audit. They could do optional audit if they wish to, but compulsory audit should be removed from those entities because this is the global practice. So this is a global trend as the NFRA sees it. I discussed with you, what are the counter arguments to it, and a lot of counter arguments are available. In fact, I went through the consultation paper, and the way in which some of the numbers are used are not necessarily the most relevant. But having said that, you at least know that how the regulator is looking at it. One just an example, is if the NFRA is assumed that this is how a certain number of hours will be spent by each and every team member of an accounting firm. Some would be spent by the partner, some hours would be spent by a manager, then there would be an assistant manager, then there would be an article, and all of them would have a particular rate per hour, and this is how they would spend time in each and every step of the audit process, which the institute has given in one of the documents. And depending on that, they've calculated what is the rent cost, what is the software cost for a small firm. And so, for example, just one, basic obvious error that you could see is, for a metro city, they have assumed that for a small firm, the rent is 325 per square feet per month. Now that's not the kind of rent that goes on in all places in for a city like Mumbai. You could find an office for as low as 50 per square feet, or you could even find the rates that they are saying. So obviously serious issues around how the numbers have been worked out. But even conceptually, as I said, whenever in India, at least whenever a promoter sets up a company, he sets up a private limited company only when he wants a difference between ownership and management, and only when he wants future investors, lenders, or because otherwise he could set up an LLP and now he could set up a one-person company. So exclude one-person company out of it. Okay, fine, but keep all other private limited companies in. Maybe that could be one of the discussion. Now, again, in the NFRA report, and this is kind of the last slide for the day. We could take up any more questions that are there after this. So NFRA notes that in June of 2021, the International Auditing and Assurance Board has issued an exposure draft of proposed international standards on auditing of financial statements of less complex entities. And the comment period ends on 31st of January 2022. India's position on this reform project is not yet clear, which also means that the NFRA is kind of hinting that for smaller companies internationally also there is a trend of having a different set of auditing standards, and we cannot have one size fits all auditing standards. And I think partly I would kind of agree to that okay, that's what is the real difference between the kind of calculation that the NFRA has done in the consultation paper and the kind of work that happens on the ground. Is because these companies are so small, you don't need to do all those steps in those entities, and therefore maybe the auditing standards can be diluted for some of those smaller entities, but that doesn't mean that you don't need an audit, particularly considering the various options that are already available for non-audited entities for a promoter. So just one small screenshot I picked up from the NFRA report, and I thought it would be a good table to leave the discussion on is, the NFRA believes that for a company with a turnover of, if you see, of 50 lakhs to 1 crore, the audit fee for a small firm in a metro city should be 5.56 lakh. You see the end? It should be, if the turnover is from 0 to 20 lakh, then the NFRA believes that the audit fee for the small firm in the metro city should be 4.5 lakh. Now, this is way above the institute's minimum recommended scale of fees, and there is certainly a big gap that has come. So the argument that NFRA is kind of making is that this is a lot of, so in fact, the audit is not happening at all because you're not charging that much fees, you're not able to spend that much time, and therefore the audit is not happening at all. So this is a very, very probably not the right way to draw a conclusion or reach at a conclusion. And there are so many aspects to be looked at as to what's happening on the ground. But I'm sure the institute will take up in the right spirit. But I'm a little skeptical that the way in which the government is kind of going, maybe we will very soon see a day where we smaller companies may be exempt from the audit requirement. Nevertheless, it does help small and medium-sized companies, at least from a cost point of view. Obviously, it doesn't help them from a reliability point of view, because their investors, their lenders will always come and say, okay, do the audit, and then they have to do for all the past years together, because investors will not be able to otherwise get the comfort that they need. So maybe a short-term benefit for a long-term issue. Thank you so much. Thank you.
Thank you, sir, for your wonderful presentation. I think it's very informative presentations, which gives a lot of privileges, opportunities, relaxations, exemptions, benefits. You covered everything. I think what whatever is applicable to the SME or the small companies, you covered many things. And lastly, you covered the NAFRA, about your views about the reports, whatever they have given. There are no more few questions are not there. Okay, you answered all the questions. So now I request my core group member, Shreyas Trivedi, to present a very well-deserved vote of thanks to the
Thank you, Hiren bhai. So, friends, in the times today, with so much ambiguity over the survival of one of the most practiced areas of audit, it is important that we practitioners think of shifting the focus of practice from compliance oriented to consulting oriented. So the insights shared today by the learned speaker and the provision discussed will help us in thinking on these lines, and especially the provisions discussed with regards to small companies, startups, MSMEs, and more importantly, the approach of NAFRA. So on behalf of BCSC, request all members present here to present a well-deserved vote of thanks for the speaker today. So thank you, Janak bhai, for your time today.
Thank you.
Thank you,
Thank you
sir.
so much. Thank you, everyone.
Thank you, sir. Thank you, sir.
We will end the session with this. Thank you.
Yes, I will email my PPT as well to you. Thank you so much.
Sure. Thank you very much.